The repo market is a tool used by the Federal Reserve that has come more and more into public eye since September of 2019 when the repo market blew up. But over the past year to year and a half, the main tool that people have been watching is the reverse repo facility. Now, I've kept my eye on this and I've been updating you, and I keep on telling you at some point the reverse repo facility will start to get drained. And when it does, that is the first sign of a coming pivot from the Fed. Right now, if you look at the reverse repo facility at the Fed, it's possible that we are witnessing the beginning of this very draining that I've been warning about for a year and a half start to take place right now. Since June of this year, the amount of money, cash, in this reverse repo facility has been hovering above $2 trillion. And now, as of November of 2022, this number has started to drop week after week with a little bit of volatility and is now getting very close to breaching that $2 trillion line. Now, if you have no idea at all what this reverse repo facility is or the regular repo market has to do with anything, I just made a new episode about this last week on my podcast, Financial Heresy. It's a podcast. You can find it anywhere that podcasts are, Spotify, iTunes, Apple Podcasts, whatever. And so you can go take a listen to that. It's like 45 minutes long, deep dive into the repo market and why it matters and what it does. In short, the repo market is where banks go to get cash when they're low on reserves. And so this would be a liquidity crunch if banks were needing to access cash in the repo market and they couldn't. That happened when Lehman blew up, and that happened in September of 2019 when the Fed started not QE again. Well, right now, there's a large amount of reserves available, which means that there's not enough collateral. So banks use the opposite pawn shop and they give cash to the Federal Reserve in exchange for collateral, and the Fed pays them interest for that cash. That's why there's over $2 trillion in this facility, because banks have to have collateral, so they take some of their cash, give it to the Fed, and get collateral through this reverse repo facility. $2 trillion are in there right now because they're making almost 4% risk-free from the Federal Reserve. Now, with everything that the Federal Reserve is doing these days to intervene in the economy, nobody ever knows whether there's going to be a money printer fired back up, prices are going to go up, everything's going to collapse. So if you want to protect yourself from inflation, deflation, crashes, hyperinflation, hedge your portfolio, make sure you're exposed the right amount to every asset class. My courses are on sale right now for the holiday season, linked in the description below. So the question is, what would the banks be doing with this if the reverse repo facility didn't exist? And the answer is they'd be buying this collateral from the open market, which would drive rates a lot lower than they are right now, considering this is $2 trillion. It would be short term. It wouldn't be buying 10-year, 20-year, 30-year treasuries. It'd be buying the short end of the curve, but that would be pushing rates down a lot lower than they are at right now. And so in order to make sure that cash stays in this reverse repo facility, the Federal Reserve has paid an interest rate 5 basis points higher than the federal funds rate to make sure that banks have an attractive option on a place to put their cash. This means that that cash is not out in the open market buying that collateral, forcing rates down, because it's more attractive to get that high rate of return from somewhere risk-free like the Federal Reserve, who has monopoly on printing money. Even the federal government can't boast this amount of risk-free with their treasuries, because you still have to pay those back through additional borrowing or taxation, and even those can fail and governments can and do default on their debt. But the place with the monopoly on the creation of money, the Federal Reserve, will always be able to just print more money. This makes it curious then that the amount of cash in the reverse repo facility is starting to fall, and that begs the question, why? Well, keep in mind that this is not something that the Federal Reserve has intentionally done at this point. What we would need to see if this was a pivot, an early pivot from the Fed, we would need to see the award rate paid in the reverse repo facility fall below the federal funds rate. Right now, they've made no change to the amount they're paying into the reverse repo facility. As you can see here, this is the chart that shows how much they're paying. They're paying 3.8%. They always keep it 5 basis points above the bottom end of the range of the federal funds rate, and they've made no change to that strategy so far. So why has money started to leave this reverse repo facility? Well, free market forces are starting to come back into play here. If you look at T-bills, which are the things that would be purchased instead of having that cash in the reverse repo facility, you can see that depending on the maturity, now you're getting to the point where rates are starting to become more attractive, even given the higher risk, more attractive here because it's higher than what they're getting from the reverse repo facility. In fact, at 3.8%, the reverse repo facility is paying higher than the 10-year treasury, but nowhere near as high as the 2-year right now at 4.23%. And given that some of these bills are paying even more, we have a severely inverted yield curve right now. So if none of that makes sense, don't worry. The money that's in this account at the reverse repo facility, banks are getting paid 3.8% on that. So there's $2 trillion getting a risk-free 3.8%. If they want a higher return, they can go buy collateral off the open market if they want and get a higher return now. That didn't used to be the case. The reverse repo facility used to pay more or about is equal as the T-bills, and if it's going to be the same, you might as well go with the risk-free option instead of the more risky option on the open market, and you have to deal with maybe if you have to sell it at a lower price than you bought it. Now, if the Fed hasn't taken any action here, then the question is, well, what is the significance then of the reverse repo facility getting drained right now? And the answer is nothing yet, but we do need to watch this because once the Fed makes a move on the rate that they're paying here, then it will become significant. There is a little bit of an offsetting of the liquidity drain that is happening through their selling assets, their quantitative tightening right now, but so far it hasn't been enough to really make a difference. What you'll hear people talk about is their balance sheet. This is part of quantitative tightening where they're selling assets off their balance sheet and letting their balance sheet roll off so that they're not injecting new liquidity. So the federal government has to borrow from the economy rather than the money printer at the Fed. This drives rates higher, and then as rates go higher, then all that liquidity that's currently sitting in hiding, getting paid risk-free money at the Fed will come out to play with those higher interest rates and provide funding for the US government. And so as interest rates move up for T-bills, for government borrowing, as government borrowing becomes more expensive, well, banks will be more attracted to provide that funding because it's more lucrative than leaving it in the risk-free place at the Fed. And this will happen automatically as the federal government's interest rates on bills and treasuries get higher. That money will start to leave the reverse repo facility and go get lent to the US government instead. Now, one potential thing that might happen that we have to watch for towards the end of the year is the end of the year spike in the reverse repo facility. We can see every quarter there's a spike above baseline here and then we return to normal, and you always get a really big spike at year end. And so we could definitely see something similar play out over the next couple of weeks. But one thing we also have to watch out for, this is the main key that I keep on saying, is we have to watch for what the Fed is paying into this facility. Because the moment that they deviate from the plan that they started back here in 2021 of offering a rate that's 5 bips over the federal funds rate, that's when we're going to see a soft pivot happen, because that's when the Fed will actually be pushing that money out. If they decide to take the rate back down to exactly the federal funds rate, or maybe even back down to zero, then all that money will flood out. It'll go buy bills and treasuries on the open market, pushing rates down, providing that little stimulus to the economy to the tune of $2 trillion or so, and it'll offset any tightening that they've done, because they're probably not going to be able to get their balance sheet down by $2 trillion by the time this reverse repo facility starts to flood out. So I'll keep watching. We definitely are going to want to pay attention to this during the FOMC meeting, where the Federal Reserve will come out and announce whether they are going to be raising interest rates by 50 basis points or 75 basis points or potentially something else. This is going to be a big one to pay attention to see if they stick with what they've been doing this entire time and keep on raising the rate that they're paying into the reverse repo facility and keep it 5 bips above the Fed funds rate, or whether they deviate from that plan and start to push those funds out. I don't think they'll actually do that. I think they'll stick with the plan and just allow a lot of those funds to drip out naturally as government borrowing costs go up, but we'll see, and whatever happens, you'll be the first to know. As always, thank you so much for watching. Have a great day.